Welcome back to another Deal of the Week breakdown. My name is Ricardo Carrillo. I run a nationwide mortgage lending team. My team and I, we help people scale their real estate portfolios from literally zero properties to 10, 15, 20 plus properties. And our goal really is to do that in the shortest amount of time possible. We have a lot of real estate investors that we work with who know that they want to build financial freedom through real estate. And that's what I spent the last 6 years working on, building structures and systems that allow these investors to be able to do that. And one of my favorite things is the fact that I love to do these deal of the week videos for all of my real estate investors, because then they get to see what other people just like them are trying to do across the entire US. Now, my team and I, we actually cover the entire US for financing, and it's a really cool place to be in, is probably the best way to put it, because I get to see like a bird's eye view of where are my investors going, what are they doing, what kind of investment properties are they trying to go after, who are the main point of contact of the people that they're working with, who are the awesome realtors or the bad realtors that we don't want to work with. And over the years, it's allowed for me to build up a really good database of not only solid, super solid real estate investors, but also really solid real estate agents. We have, I think at this point, a little bit over 2,000 realtor partners that we work with across the US. And it allows for me to continue to give back those totally free resources to all of our real estate investors. Now, this is a little bit of a unique video because this one is more towards the people who don't think that they can qualify for normal financing. You know that when we're thinking about qualifying from a bank's perspective of like, how am I going to be able to purchase more real estate? How am I going to be able to get more financing? One of the biggest questions is people thinking like, oh, well, like I don't fit into that cookie cutter box, right? And needing to say, hey, like the bank's not going to approve me because my taxes don't look good, or my income's a little weird for the last couple of years, or I don't have income anymore, I'm only on Social Security, or whatever the case might be. The matter of the fact is, you actually don't need income in order to purchase real estate. There's many, many loan programs across every single state that allows for you to buy in unique fashions. I mean, at this point, my team and I, we have access to a little bit over 130 different banks that we work with. Not only that, but we also have close to 3,000 plus different loan programs. And so I really see everything from raw land loans that people are doing to, our clients of ours that are buying 20 plus unit apartment buildings or buying portfolios of 50 plus real estate properties. So it really ranges in terms of the strategy and what works. And my personal investing standpoint is, as an investor, I like to be conservative. I want to use higher numbers when I'm estimating if my property is going to cash flow or not. I also like to be conservative on like monthly payments, right? We want to make sure that we have a slightly higher monthly payment in our calculation, so that if you're buying a property that's going to cash flow, then it's, of course, it's going to cover the payment, and we'd be good to go. So those are some of the things that we want to look at. We also want to look at trying to minimize how much money we're bringing to the table. Every real estate investor who has tried to go after properties knows that the most difficult thing of this entire process is, where do I get the money for this deal? Thinking about it from an investor standpoint myself, I want to put as little as money possible into a deal, as little as I can. And so that helps me continue to put more money into more and more investment properties. I limit how much I'm spending on one deal. Let's say you're doing 20, 30% down, you can cut that into multiple properties and put that into various deals, as opposed to just doing it on one. This deal was a little unique, and the reason I say it's unique is really just because of the loan program that we utilized. We utilized a loan program called a DSCR loan, which stands for debt service coverage ratio. Now, debt service in simple terms is just, can your property rental income, or whatever kind of rental income you're generating, can it cover the mortgage payment? That's debt service. Like, will property cover its own debt? That's a debt service. That's what debt service would mean. And then debt service coverage ratio means, how much rental income are you bringing in relative to your payment? So for easiness, if we have $1,000 mortgage payment and we have $1,000 in rental income, that's a 1-to-1 ratio, because they're equal. Most lenders want to see at least a 1-to-1 ratio. We do have banks who actually don't care. Like, you don't even need to be generating revenue in order to be able to get the property. But for this program specifically, it's meant for people who don't want to use their income to qualify, or you want to close in an LLC, you want to have less documentation that you're providing. It's a little bit easier on the review process, and making sure that you can get your loan approved and going through all of the paperwork. And so that ends up being a big reason as to why people try to utilize a program like this in order to purchase more real estate. Jumping into the specifics, this client actually purchased a brand new construction property, had been sitting on the market for quite some time. It's in the state of North Carolina. So I do have a lot of investors in North Carolina. Seems that North Carolina is really good for Airbnbs, as well as long-term rentals. But this specific client, they were purchasing a short-term rental. It was a single-family house sitting on just under a quarter of an acre. Total living square footage was 1,400 square feet, and it was a three-bedroom, three-bathroom house. You guys can kind of follow along of what we were doing here. But so loan type for this deal was DSCR. It was a debt service coverage ratio loan. We needed at least a one-to-one debt service, and property type was single-family home. The property actually sat on the market for almost 80 days, which is I mean, I would say that that's pretty normal for around the time of when this client purchased their property, mainly because of the fact that like houses have just been sitting on a little bit longer, and some new construction properties, might be a little bit overpriced in terms of what's actually might be overpriced. And so, most people end up coming back to the negotiating table to try to make the deal work, which is what we did here. Now, the property ended up appraising for 255,000 and also purchased for 255,000. Down payment minimum was actually 20%. That was what they decided to put. However, the actual minimum would be 15%. I have banks who will go as low as 15% down on a non-conventional loan like DSCR. DSCR is just a type of non-conventional loan. And one of the easiest ways that I like to explain it to my clients when we're thinking about banking or mortgages specifically is like the further that you move away from providing paperwork to the bank that you're working with, the further that you move away from providing paperwork to the bank that you're working with, like less documentation that you're turning in, the worse the terms of the loan are going to be. That's just naturally, from a risk standpoint, how banks are operating. They're going to say, hey, you're not providing anything besides bank statements. You're not providing anything for me besides some rental income and a credit report. Like, of course, the terms are going to be worse than if you were to get like a normal traditional loan where you're providing pretty much everything except for like a blood sample. At this point, they really want to collect a lot of stuff. A lot of investors tend to opt for programs like this. My personal opinion, it's not the program that I jump into right away. I love this loan program. I've used it myself. It's really good for scaling real estate portfolios, but it's not the first loan program that we should jump to when you're thinking about getting into real estate. It really is for more seasoned investors or investors who have very, very complicated financials. Again, minimum down payment is 15% down, and we ended up doing 20% on this deal, which off of 255K comes out to be 51,000 even. Now, loan was for 80%, so that was the 204. Interest rate was actually really good. We ended up locking in at a 6.875, which most non-conventional loans, kind of the rule of thumb that I like to advise my clients on is saying, hey, if you're buying a property that is with conventional financing, a normal loan, most non-conventional loans, like DSCR, for example, tend to be about 1% higher than what we would see on a regular conventional loan. In this situation, it wasn't. I would say this is really close to where conventional interest rates were at the time that this client purchased. And we ended up doing a 30-year fixed term, which is most common. There are other options. You have options like interest only. You have options like adjustable rate mortgages. You even have a 40-year fixed option. So there's variety when it comes to non-conventional loans. But again, it just matters of like, hey, let's look at the whole picture. Does it make sense to have a lower monthly payment for more cash flow, even though you're paying more interest over the life of the loan? Or does it make sense to do interest only for qualifying? So these are kind of the things that my team and I will walk through when we're analyzing a deal and saying, hey, we're pre-approved already. Let's go look for properties. As we're looking for properties, let's think about it from an investor standpoint. What's the smartest financial decision for how we should structure the financing on this deal so that we know, hey, the long-term goal is I want to buy 5 properties over 5 years. Great. Let's keep that in mind, and let's think about how we're structuring the current deal today so that we're maximizing your dollars, making them go as far as possible. Principal and interest payment came in at 1,340 with 13 cents. Homeowners insurance came in at $93.58. That was pretty cheap. Property taxes were at $292 with 83, which also not super expensive. There is no PMI. So PMI is private mortgage insurance, very common for a lot of traditional loans. People think that when you're purchasing a property that you're putting less than a 20% down payment on, it actually requires for you to bring money to the table in the form of PMI, where you're basically paying for the bank's insurance policy. Private mortgage insurance, which is PMI, is essentially an insurance policy that the bank is getting to essentially cover themselves in case you don't make your payments. Now, on programs that are non-conventional loans, it doesn't apply. PMI does not apply, even if you're doing less than 20% down. It's already a riskier loan. They're just kind of like, hey, I don't care about it. We're not going to collect that money. But, so there's nothing to factor in for PMI. There was also no HOA on this one. And then the total monthly payment comes out to 1,726 with 54 cents. So our total payment being, let's call it 1,800 for easiness. That means that the only thing that we needed in order to get this loan to be approved is for the appraiser or for websites like AirDNA, for example, that show revenue data to show more than $1,800 a month, which is very easy for this market, especially where most long-term rentals in this area are going to go for $2,500 plus, especially on a new construction property. A property like this on Airbnb, would probably do well over $4,000 a month. And so we ended up having zero issue whatsoever in securing the financing because we had no problem covering a $1,700 payment on this property. And that's what allowed the client to then qualify. We needed pretty much nothing else besides showing, hey, the property appraised for the value that you're buying it at came in at 255. You're buying it for 255. The rental income covers the mortgage. That's it. The bank's saying, okay, great, you're good to go. We know you're going to be able to cover the payment on this property. You just need to have the money for the deal. And that's the beauty of loan programs like this. Like, it doesn't have to get super complicated. Now, trust me, there are ways that we can make it very complicated if you're buying in a super weird location or it's a really weird property. Like, I had a client who was funny enough to try to purchase an underground property with this same loan program, which gets into its own sort of issues. But it is a really good loan program for people to think about using or saying, hey, I want to hear more about DSCR. I don't know anything about DSCR. I want to use it to buy more real estate. Does it make sense for me? That's the question that I always ask when people come to me and they say, hey, Ricardo, or they're working with my team and they're saying, hey, we want to buy with a DSCR loan. My initial question is, why do you want to purchase with DSCR if it doesn't necessarily make sense for your specific situation? Let's not even look at it. Because the thing is that in today's day and age, especially after COVID and especially after interest rates have had their ups and their downs, everyone seems to think that DSCR loans are these amazing loan programs, which, don't get me wrong, DSCR is an amazing loan program, but it doesn't make sense for everybody. And so this is why I always say, let's have a conversation. It's all about coming up with a game plan. Does it make sense to purchase with this kind of loan program, or does it make sense to purchase with something else that might actually even save you more money? You'd never know unless we had that conversation. Continuing on here, the total closing costs ended up coming in at $14,701, which was actually a little bit expensive for this area just due to the closing costs on the buyer side. They ended up incurring a little bit more closing costs. Seller credits came in at $1,000, so we really only had that $1,000 to alleviate some of the closing costs here. And then we had another $1,000 for adjustments and other credits. Now, adjustments and other credits is essentially just the year of when you're closing on the property, and if there's something that needs to be paid back to you from the seller, that's what happens with adjustments and other credits. It's kind of like towards the very, very end of the transaction, we'll see if there's some money that's going to be given back to you. We don't really include it in calculations because it comes directly from the title company who's working on your deal. And then that leaves our total out of pocket at $63,701 with 29 cents. So 60 grand, the property is going to be really good at cash flowing for our client. We know it's going to generate more revenue than the mortgage payment. And that's all we really needed to be able to qualify. It was just making sure you have over a 600 credit score. This client was well into the 800s. And then making sure you have the money for the down payment. Now, I advised the client and saying, hey, you didn't need to do 20% down. They were more comfortable at being 20% down. Most of my investors that go after this loan program, we actually use 15% down. That's one of my preferred ways of using it for my own real estate deals. And yeah, I just want to be able to show you guys what's actually possible from a financing standpoint. It doesn't have to be the cookie cutter stuff. This loan program, programs like these, Chase Bank, US Bank, Wells Fargo, those big banks, none of them are even going to know what you're talking about. If you went to them and asked for it, you'd only be able to get a program like this by working with a team like ours. And we specialize in a lot of non-conventional loans. This kind of loan program is actually about 50% of our volume. We do a ton of non-conventional loans. We've been specialized in non-conventional loans since 2019. And it's allowed for me to be able to see what's possible with alternative kind of financing because let's be frank, in today's day and age, not everybody fits the cookie cutter box that banks want you to fit into, and that's okay. We don't have to. There's ways around it, and there's ways that we can leverage programs like these to help you scale your real estate portfolio. So, if you guys have stuck around this long, I really, really appreciate it. It's fun for me to be able to show you guys what's possible with our other real estate investors, what they're working on that allows other people to say, "Hey, I want to do the same thing," or "Ricardo, can you put me in touch with that client?" Which is funny because I have had people who've done that, and I have no problem with putting you guys in touch with my other real estate investors. And so, yeah, if you guys have stuck around this long, I really, really appreciate you guys. Please watch my other Deal of the Week videos if you haven't seen them. They'll be here, or here my team will put them up. But I will see you guys in the next Deal of the Week. Peace out.